The post-pandemic housing market is no longer synchronized. While the years from 2020 to 2022 saw record high prices and frenzied buying across borders, the current global picture is far more fragmented. Interest rate hikes, inflation, local policies, demographic shifts and even climate pressures have pulled national markets in different directions. Here's how real estate is reshaping across key regions in 2025. In the United States, home affordability has deteriorated sharply. Mortgage rates above 6.5% have pushed many potential buyers out of the market. In Florida, a once red-hot destination, cities like Miami and Tampa are seeing home price drops of nearly 4% and 6% respectively. Many sellers are refusing to lower asking prices, instead pulling listings altogether. Skyrocketing home insurance premiums, especially in coastal areas, are adding to the financial strain, with average annual premiums reaching $6,000 in parts of the state. Canada, meanwhile, is in the midst of a slow correction. Nationally, home prices have fallen nearly 4% compared to 2024, with Toronto and Vancouver seeing stagnation, while smaller cities like Calgary have shown relative resilience. Government policies such as foreign buyer bans and taxes on vacant homes have curbed speculative investment, but affordability remains out of reach for many Canadians, especially in the rental sector, where supply remains constrained. The property markets in Australia and New Zealand are moving in opposite directions. In Australia, house prices continue to climb despite economic headwinds. Sydney's median price has passed $1.23 million Australian dollars, with Brisbane, Perth and regional Queensland also posting strong growth. Although price growth has slowed, demand remains high, driven by lifestyle migration and low housing stock. The rental market is particularly strained, with vacancy rates hitting record lows. In contrast, New Zealand has undergone one of the most pronounced corrections globally. Home values have fallen back to 2019 levels, following interest rate hikes, a foreign buyer ban and tighter credit conditions. While this brings some relief to local buyers, developers and landlords are feeling the pressure amid softening rental yields and a slower-than-expected recovery. In China, the real estate sector has experienced a deep contraction, with housing prices down 20% since 2020. A 4 trillion yen stimulus package has been introduced to revive stalled projects and support developers. The government has also relaxed mortgage rules and reduced interest rates. While these efforts may stabilize the market, confidence remains low, and oversupply in smaller cities continues to pose risks. India, on the other hand, is charting a more stable course. Cities like Mumbai are seeing sustained demand, especially in the mid-income and premium housing segments. Infrastructure investments and a growing middle class continue to support long-term growth. Developers are shifting focus to more livable, efficient spaces as urban expansion accelerates. In France, especially Paris, high prices and rising borrowing costs are cooling demand. Government reforms on rental regulation and taxes are discouraging speculative purchases, though limited supply in prime locations is helping prices remain relatively stable. Spain remains attractive to foreign buyers, especially in cities like Madrid and Barcelona. However, regulatory uncertainty around short-term rentals and potential rent caps is causing some hesitation. Still, the overall market has stabilized and price growth remains modest. Portugal continues to draw international investors and digital nomads, especially in Lisbon and coastal regions. Yet recent restrictions on golden visa schemes and tax incentives for foreign residents may slow international inflows moving forward. Across much of Europe, the era of speculative property booms appears to be over. What remains is a slow, policy-sensitive market with growing emphasis on affordability and rental reform. Latin America's real estate landscape is as diverse as its cultures. While some cities face instability, others are experiencing a quiet resurgence in investment and urban renewal. Argentina, despite economic turmoil, continues to offer intriguing property opportunities, particularly in Buenos Aires. Decades of cyclical instability have made locals and foreign investors alike cautious, but the sharp devaluation of the peso has created an appealing environment for dollar-holding buyers. Cash transactions dominate the market, and well-located three-room apartments in the city are increasingly scarce under $200,000. However, access to credit remains limited, and inflation pressures pose long-term risks. Mexico remains a regional leader, with Mexico City maintaining stable demand and attracting international interest. Rental yields are solid, and infrastructure development supports long-term urban growth. Colombia, particularly Bogotá and Medellín, has recovered remarkably from past political and economic turbulence. Foreign investment is returning cautiously, aided by a growing tech sector and improved urban planning. In Peru, Lima is seeing growing demand among domestic buyers and returning expats, although inflation and interest rate volatility have tempered the momentum. New construction is limited, creating a potential supply-demand gap in the years ahead. Chile's market in Santiago is stabilizing after years of political upheaval and protests. While credit is tighter and regulatory shifts are ongoing, demand remains stable in core areas. Across the region, Latin American real estate offers a paradox. Constrained credit and inflation risk coexist with relatively affordable pricing, high rental yields and untapped growth potential in middle-income housing. The global housing market is no longer defined by a single trend. Instead, 2025 is marked by a regional decoupling. Some countries are still correcting, others are stabilizing or growing cautiously. Interest rates, policy reforms, investor sentiment and economic resilience are reshaping housing, and doing so differently in every corner of the world. For investors, developers, and policymakers, the key takeaway is this: real estate can no longer be approached with a one-size-fits-all mindset. Local realities matter now more than ever.